Hey guys, so today I have this new trading strategy which I'm going to backtest for you over 100 trades. I will tell you about the indicators we're going to be using, show you a few examples, and then perform the 100 trade backtest for you. So this strategy involves two indicators, the famous Ichimoku Cloud and the average true range. So the Ichimoku Cloud is a group of technical indicators that displays support and resistance levels, as well as momentum and trend direction. It accomplishes this by plotting numerous averages on a graph. It also employs these numbers to create a cloud that seeks to forecast where the price might find future support and resistance. So here are some details about how the Ichimoku Cloud and the average true range indicators are calculated. So if you are interested into exactly how the Ichimoku Cloud is calculated and all of its components, there will be a section at the end of the video. So this backtest is based on the 4-hour time frame with a 1-to-3 risk-reward ratio, which means every dollar that we risk, we aim to make $3. So here is the strategy. A buy signal is formed when the green line, known as the Chiku line, rises from below the price action to cross above it. And similarly, a sell signal is formed when the Chiku line, the green line, crosses below the price action. The second rule is that we place the stop loss at 1 ATR. The third rule is we can only have a maximum of 2 trades, one long and one short at all times. And another key rule is that we move the stop loss to break even as soon as the profit is equal to the max risk per trade. And the fifth rule is we keep a 1-to-3 risk reward ratio. So this strategy is offline, which means I will go back in time on the charts to test this strategy and see how it would have performed. So therefore, it does not take into account commissions or even the spread. If you don't know what that means, the spread is the difference between the bid price and the ask price. So at any given time, you can buy or sell an instrument. Usually the broker's commission is the difference between the price at which you will buy the asset, which is called the ask price, and the price at which you will sell the asset, which is called the bid price. All right, so let's get on the charts now so I can show you a few examples of the trades, and then we will dive into the 100 trades backtest. So here we are with a few examples of trades that follow the strategy that we just covered. So here the cloud turns red, so we go short with a stop loss of 1 ATR. So as you can see here, 19. We take a short with a stop loss of 19, a 1-to-3 risk reward ratio. So the key of this strategy in risks management is that as soon as the ongoing profit reaches the amount that we risk, which in this case is 19 pips, we move the stop loss to break even. So as you can see here, the price doesn't hit our take profit. However, throughout the life of the trade, we reached 19 pips. So we would have moved our stop loss to break even. So instead of the trade being a loser, it's a break even trade. In this case, it's a loss. So the cloud turns green. We go long with a 1 ATR stop loss, which is 21 pips. And it doesn't even reach 21 pips. So we take the loss. Right here, the cloud turns red. We've got a pretty tight stop loss, which is 18 pips. So our take profit isn't hit, but similarly to one of the previous trades, we do reach the break-even point. So this would have been a break-even trade. Same for this. The cloud turns green. We've got a stop loss of 19 pips. We reached 19 pips. So the stop loss would have been moved to break even. And here, instead of the trade being a loser, it's a break even trade. We move along. So here the cloud turns red. We've got a 15 pip stop loss with a 1-to-3 risk reward ratio. So this is a winner. And then the next one, the cloud turns green. We take a long with a 25 pip stop loss. We reach the 25 pips within the life of the trade. So this would have been a break-even trade. So as you can see, this technique allows recovering from losing trades. So this will definitely improve the performance of the strategy. All right, so let's go ahead and do the 100 trade backtest, and I'll see you for the results. So there you go, guys. The results of the backtesting. It's a pretty bad strategy. To be honest, I thought it was going to be a lot worse than that, simply because of the number of losses. But the fact that we were moving the stop loss to break even recovered a lot of the losses. So that was really key. So that's a key takeaway. So we risked 5% of the account on all trades. We had a maximum drawdown of 38%. We had 21 wins and 79 losses, with 2 wins in a row and 8 losses in a row. That gives us a win rate of 21%. So it's not amazing. So, you know, a few things that could be improved would be to increase the risk to reward ratio. So, you know, going from 1 to 3 to, you know, 1 to 5 or 1 to 7 or 8 even. That would be a good test to do. So we ended up taking a loss of 9.1% over 872 days. So there you go. Let me know what you guys think, and if you can think of any new strategies that you want me to backtest, let me know in the comments. See you in the next video. Goichi Hosoda, a Japanese journalist, created the Ichimoku Cloud, which was first published in the late 1960s. It has a larger number of data points than a traditional candlestick chart. While it may appear sophisticated at first glance, individuals who are accustomed with chart reading will find it pretty simple to comprehend with well-defined trading indications. So how do you calculate the Ichimoku Cloud? So in the case of the conversion line, the highs and lows are the highest and lowest prices seen throughout the period. For example, the highest and lowest prices seen during the last 9 days. The calculations will be done for you if you add the Ichimoku Cloud indicator to your chart. But if you want to do it manually, follow these steps. So you first calculate the baseline and the conversion line. Then based on these calculations, you calculate the leading span A. So this data point is calculated and projected 26 cycles into the future. Then you determine the leading span B, where you plot this data point over the next 26 periods. Then you plot the closing price 26 periods in the past on the chart for the lagging span. And then to make the cloud, the difference between the leading span A and the leading span B is colored in. Then you color the cloud green when leading span A is greater than the leading span B, and you color the cloud red when the leading span A is less than the leading span B. One data point will be created as a result of the preceding processes. To make the lines, you go through the procedures again as each period ends to create new data points for that time. And then to produce the lines and cloud effect, you connect the data points together. So what exactly does the Ichimoku Cloud tell you? So using averages, the technical indicator displays relevant information at glance. When the price is above the cloud, the overall trend is up. And when the price is below the cloud, the trend is down. And when the price is in the cloud, trend is trendless or transitioning. So when leading span A rises and crosses above the leading span B, the uptrend is confirmed, and the space between the lines is typically colored green. When leading span A falls and falls below leading span B, it confirms the downtrend. In this case, the space between the lines is typically colored red. Traders will frequently use the Ichimoku Cloud as a level of support and resistance based on the price's relative position. Levels of support and resistance are provided by the cloud. So this distinguishes the Ichimoku Cloud from other technical indicators, which only provide support and resistance levels for the current date and time. So to maximize risk-adjusted returns, traders should use the Ichimoku Cloud in conjunction with other technical indicators. For example, the indicator is frequently used in conjunction with the Relative Strength Index, the RSI, which can be used to confirm momentum in a particular direction. It is also necessary to consider the larger trends in order to understand how the smaller trends fit with them. For example, during a very strong downtrend, the price may temporarily push into and slightly above the cloud before falling again. But by focusing solely on the indicator, we would miss the larger picture, which showed that the price was under strong long-term selling pressure. Crossovers are another way to employ the indicator. When the price is above the cloud, look for the conversion line to move above the baseline. This can be a strong buy signal. One strategy is to keep the trade open until the conversion line falls back below the baseline. Any of the other lines could also be used as exit points.